Have you ever looked at a stock chart and wondered what on earth is going on? Why does it go up like a rocket, only to crash back down to earth? Well, a huge part of the answer isn't in complex financial models or secret formulas. It's right here, inside our heads. Today, we're diving deep into the psychology of market cycles, exploring the emotional roller coaster that drives investors and shapes the markets we see every day. So, what exactly is a market cycle? Think of it like the seasons. You have spring, when things are growing and optimistic. Then comes summer, full of excitement and peak growth. Autumn follows, with things starting to cool down. And finally, winter arrives, a period of decline and hibernation before the cycle begins anew. Stock market works in a very similar way, driven by the collective emotions of millions of people. It's a fascinating dance between greed and fear, optimism and pessimism. Start at the beginning of a cycle. This is the phase of disbelief. A market has just gone through a tough time, maybe a crash or a long bear market. Prices are low and the general mood is skeptical. People who got burned before are saying, this is just a temporary bounce. Pie. It's a trap. They're cautious, and only the most contrarian investors, the ones who love to go against the crowd, are quietly buying. They see value where others see risk. For most people, the memory of the last downturn is too fresh, too painful. They're watching from the sidelines, convinced it won't last, okay? But then, something starts to shift. The market doesn't crash again, okay? It starts to slowly, steadily climb. This brings us to the next phase, hope. People begin to think, maybe this recovery is for real. The financial news starts to sound a little more positive. You see more green arrows than red ones. More investors begin to dip their toes back into the water. They're still a bit nervous, but the fear of missing out, or FOMO, is a powerful motivator. The feeling is one of cautious optimism. The rally is gaining strength, and it feels like things might actually be getting better. And then, hope blossoms into full-blown optimism. This is where the fun really starts for many. The market is now in a clear uptrend. Everyone who bought in during the hope phase is feeling pretty smart. The news is overwhelmingly positive. Economic data looks good. Corporate earnings are strong. It seems like you can't lose. Your friends start talking about their stock market wins at dinner parties. This is when the general public really starts to pile in. The skepticism is gone, replaced by a confident belief that this is the new normal. Prices are going up, and it feels great. From optimism, we escalate into belief. At this stage, investors aren't just optimistic. They are true believers. They've developed strong convictions about their investments. They tell everyone who will listen why this time is different. Old valuation metrics are dismissed as outdated. New paradigms are invented to justify ever higher prices. This company is going to change the world. This technology is the future. People start borrowing money to invest more. They're not just buying stocks anymore. They're buying into a story, a dream of endless growth. The logic becomes secondary to the narrative. Next stop, thrill. The market is moving up parabolically. It's almost vertical. Gains that used to take a year are now happening in a month or even a week. People are checking their portfolios multiple times a day, watching their wealth expand at a dizzying pace. It's intoxicating. Strangers are giving stock tips. Everyone feels like a genius. This is the point where people quit their jobs to become day traders. Caution is thrown to the wind. The primary emotion is pure excitement and adrenaline. It feels like a party that will never end. And that brings us to the peak. It's the point of maximum financial risk. This is the stage of euphoria. This isn't just a thrill. It's a sense of invincibility. People believe prices can only go up. The idea of a crash seems ridiculous, a distant memory from a bygone era. The media is cheering it on, celebrating new market highs almost daily. This is when you hear the classic, dangerous phrase, "This time is different." everyone is fully invested. There are no more buyers to push prices higher because everyone who could possibly buy has bought. The last ounce of caution has been squeezed out of the market. And right at this peak, the smartest investors, the ones who bought in during the disbelief phase, are quietly selling their positions to the euphoric crowd. Then the mood begins to sour. The first subtle sign of trouble appears. The market has its first significant drop, but most people are in denial. They dismiss it as a healthy correction, a buy-the-dip opportunity. This is the complacency phase. After such a long run-up, a small downturn doesn't seem threatening. It's just taking a breather before the next leg up, they say. They are confident the party isn't over. They've been conditioned by months or years of positive returns, and their belief system is hard to shake. They hold on, and maybe even buy more, convinced the good times will roll again. But the market doesn't bounce back strongly. It tries, but fails to make new highs. And then it falls again, this time a little harder. This is when anxiety starts to set in. The confident talk quiets down. Investors start to realize that this might not be just a simple dip. The gains they made are starting to shrink. They stare at their screens, a knot forming in their stomachs. It's a question, what if I'm wrong, starts to creep into their minds. The easy confidence of the bull market is replaced by a growing sense of unease. Anxiety then turns into denial. The market continues to decline, but people can't bring themselves to sell. Selling would mean admitting they were wrong, and it would lock in a loss, turning a paper loss into a real one. So they hold on, telling themselves, it'll come back. I'll sell when I get back to even. They avoid looking at their portfolio. They stop talking about the stock market. It's a psychological defense mechanism to avoid confronting the painful reality that their wealth is evaporating. But the market doesn't care about their feelings. It keeps falling. Denial gives way to fear. The drops are now steep and scary. The news has turned negative. The narrative of endless growth is shattered. People see their portfolio values plummeting day after day. The dream of early retirement is replaced by the nightmare of losing their life savings. The fear is palpable. The adrenaline of the thrill phase is now a cold sweat. Investors are starting to realize they are trapped. Fear intensifies into desperation. People are now willing to do anything to stop the pain. They might start selling some of their positions, thinking, I just need to get some of my money out before it all disappears. They might pray for a bounce, any bounce, just to sell at a slightly better price. They look for someone to blame: the government, the central bank, market manipulators. They are no longer thinking rationally. They are reacting emotionally, driven by a primal need to survive the financial onslaught. From desperation, we plunge into panic. This is the moment of capitulation. The selling becomes frantic and indiscriminate. People are selling everything, good assets and bad, just to get to cash. Get me out at any price is the prevailing sentiment. This is when you see those huge, terrifying drops in the market. Volume spikes. It's a fire sale, and everyone is rushing for the exit at the same time. The logic is simple. Stop the bleeding, no matter the cost. And finally, we hit the bottom. This is the phase of despondency and depression. The panic selling has exhausted itself. The market is a wasteland. Investors who held on all the way down are completely demoralized. They've lost a significant amount of money. They swear off stocks forever, saying the market is a rigged casino. I'm never investing again. The general mood is one of utter hopelessness. The news is terrible. Everyone is convinced that things will never get better, And it's right here, in this pit of despair, at the point of maximum financial opportunity, that the cycle begins again. This is where the contrarians from the beginning of our story start buying again, seeing incredible value where everyone else sees only ruin. So, why is understanding this emotional cycle so important? 'Cause If you can recognize where we are in the cycle, you can avoid getting swept up in the mass hysteria. You can resist the urge to buy at the peak of euphoria and panics at the bottom of despair. The legendary investor Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." This is the psychology of market cycles in a nutshell. It's about managing your own emotions and thinking independently. The market is a mirror reflecting our collective human nature. It reflects our greed, our fear, our hope, and our despair. By understanding this psychological roller coaster, you're not just learning about finance, you're learning about yourself. You can become a more disciplined, more rational, and ultimately a more successful investor. It's not about timing the market perfectly. No one can do that. It's about understanding the emotional tides and making sure you don't get swept out to sea. So the next time you see the market going wild, take a step back. Ask yourself, what emotion is driving the crowd right now? Is it euphoria? Is it panic? By identifying the dominant emotion, you can position yourself on the right side of the psychological wave. And that, my friends, can make all the difference. Thanks for watching today. I hope this look into the psychology of the market was helpful. If you found it interesting, please give this video a thumbs up and consider subscribing for more content on investing and finance. Let me know in the comments which phase of the cycle you think we're in right now. See you in the next video.